Welcome to today's video on one of the most popular metrics used by investors to evaluate stocks, the PE ratio. If you're new to investing, you might be wondering what exactly the PE ratio is and how it can help you make better investment decisions. Well, in this video, we'll answer those questions and more. So let's get started. Before we dive into the specifics of the PE ratio, it's important to understand that stock prices can fluctuate based on a wide variety of factors, including a company's earnings, growth prospects, and overall market conditions. This is why it's important to use different metrics when evaluating stocks, one of which is the PE ratio. So, what is the PE ratio? PE stands for price to earnings ratio, and it's a metric used to measure a company's valuation relative to its earnings. The formula for calculating the PE ratio is simple. You take the current market price of a stock and divide it by the company's earnings per share, or EPS. Let's take an example to make this clearer. Suppose a company's stock is currently trading at $100 per share, and its earnings per share over the past year were $5. In this case, the PE ratio would be 20, which is calculated by dividing 100 by 5. So what does this mean? Well, the PE ratio can be interpreted in a few different ways, depending on the context. For example, a high PE ratio may indicate that a company's stock is overvalued, while a low PE ratio may indicate that it's undervalued. In general, a PE ratio of around 15 to 20 is considered average, although this can vary widely depending on the industry and other factors. If you're enjoying our content and want to see more, we'd like to ask you to like and subscribe to help us with the YouTube algorithm. Thanks. So how can you use the PE ratio when evaluating stocks? One common approach is to compare a company's PE ratio to those of its peers in the same industry. For example, if Company A has a PE ratio of 30, while its main competitor Company B has a PE ratio of 15, this may indicate that Company A is overvalued relative to its earnings. Of course, it's important to remember that the PE ratio is just one metric, and it shouldn't be the sole basis for your investment decisions. You should also consider other factors, such as a company's growth prospects, financial health, and competitive advantages. In addition, it's important to keep in mind that the PE ratio can fluctuate over time based on changes in a company's earnings or stock price. So, it's a good idea to keep an eye on a company's PE ratio over time rather than relying on a single snapshot in time. And that's it. Now you know what the PE ratio is and how to use it when evaluating stocks. As always, remember to do your own research and seek professional advice before making any investment decisions. Don't forget to like and subscribe, and thanks for watching. See you in the next video.